Okay, I'll just check you guys can hear all right. Does sound okay over here? That's good? Okay. What about you guys at the back? You okay for sound? Yep. And what about you guys down here? You okay? Yeah. Okay. Right. Let's see. Is it time? That's long. Is that slow again? That's slow. Okay. Okay, so we'll make a start. Today we begin the topic of the equity markets, and this should take us today, tomorrow, and hopefully we'll finish this on Friday. Just a reminder that the online quiz opened this morning, so make sure you take the quiz. So this is an outline of where we're going to go. We're going to talk initially about the various types of stocks, of which there are three of them. Then we'll talk about the primary and secondary markets, some methods of valuation. This overlaps with both 201 and we do a little bit in 205, the valuation methods. Then talk about, missed out the regulators, very important, the regulators there. And then we'll talk about individual stock risk and then the market risk as well. Because most of the time in this course when we talk about a risk, and there should be a risk premium because of it, we don't make any effort or do not explain any way of converting a risk into a risk premium in terms of what interest rate you want on your investment. This is the one place where we do it. We actually get one particular measure of risk in the stock market, and we have one particular way that we deal in this course of converting that risk into a required rate of return. So this is the only part of the course where we actually do this. And then we'll talk about stock market indices and the stock market as a forecaster. So go to the types of stocks. There's actually sort of three types. There is a convertible one, but we'll start with these two here, the ordinary shares and the preference shares. What are the distinctive features of these things? Take the common stock for a start. Does anyone have any idea of any features of common stock as a security? If you bought it, any rights it would confer upon you, any obligations? Yep. Voting rights. So that's the first thing. The reason you have a voting right is because you're a part owner of the corporation. And so in practice, you don't get a lot of say in the actual running of the company. Your involvement in the running of the company usually is restricted to voting. They have an annual general meeting, sometimes a special meeting, and you're entitled to vote for your board of directors and any other motions that are put before it. So voting is one thing you get. Anything else you get? Any obligations you may have? Okay, so as an investor, your rewards come from two sources. One is from dividends, typically paid out of profits. And the other one is you can have a capital appreciation. That is, if the corporation does well and becomes more valuable, we hope that's reflected in the stock price. And so you'll get a capital gain with it. Anything else? Okay, so in this case, if the company falls upon hard time and goes out of business, then if you line up all the creditors, the stockholders, common stockholders are right at the bottom there at the very last. So everybody else in this long queue of creditors must be paid before the stockholders get anything. And in general, if a company goes under, that comes out at nothing. And so when we're thinking about the risks of the stocks relative to a bond, the risk is significantly higher by buying common stock than buying a bond from the same issuer, because you're down the bottom in terms of a default. So the risk is higher, and as a consequence of that, we do want a higher return when we invest in stocks than we do when we invest in bonds. Anything else? Okay, well, roll over and see if we missed a few things, or... Okay, so there's the thing about voting, there's the thing about the last claim. This is one of the benefits of it, though. If the company goes under, and let's say, for example, as in typical, when these things go under, it actually owes more than it can pay. So that means that people like bondholders and so on, they will be out of pocket as well. They'll lose some money. They can't come after you as the owner of the corporation to make you pay for the debts of the company. So this legal, what we call limited liability, protects you against having your personal wealth taken to pay the debts of the company. So if you have invested in a share in a company, your maximum loss is 100%. They cannot come after you to ask you for further money. Now that is different if you're like a little business, typically you have your own business, they can actually come after your personal wealth if it's not structured as a limited liability company. So the vast majority of large firms are structured this way, even though many are structured as companies. Not all of them are actually listed on share markets. Some are privately held. Now, when it comes to paying the dividends, in New Zealand and Australia we have what's a relatively uncommon way of paying out, which is actually quite good compared to the rest of the world. So we have this thing which the Australians call a franking credit, and in New Zealand it's called an imputation credit. So if you think about how on earth this works, let's say this is your piece here as the owner of the corporation, and there was $1,000 of profits that are attributed to the shares that you own. And what happens to that $1,000 is typically there will be some tax on it from the corporation's point of view. So in New Zealand, the maximum corporate tax rate is 30%. So let's say this is a good corporation, pays its taxes. And so out of this, $300 will end up as tax, and that'll head out to the government. And so when the company pays its dividend, and let's say it pays the rest out rather than keeping any, it will pay the remainder, which is the $700 to you. So that's your net dividend here. Now, in most places in the world, you will be taxed on that $700 payment. So whatever your marginal rate is, you simply pay. You declare that on your income tax form, and you pay whatever the tax is. Now, the problem with this, the way most of the rest of the world works, is that they've already paid $300 on tax, and now they're asking you to pay more tax on that $700. So what we do in New Zealand and Australia is that we have what are called imputation credits. So whatever tax is being paid by the corporation, you're allowed to claim that when you actually file your tax return. So what you actually get on your statement, there's actually four of them, but they'll have a gross dividend, and in this case, the gross dividend is $1,000. They'll have an imputation credit, and in this example, they were paying the full amount, so they paid $300, and that's your imputation, and then you have a net dividend. And in this case, it's $700. So when you fill out your tax return in either Australia or New Zealand, you put in your income the gross dividend of $1,000. There's also a place on that tax form to put in the imputation credit of $300. And for most people, even those on the highest tax bracket, this covers pretty much all your tax liabilities. So if you think the top tax rate for a corporation is 30%, so that pays $300. For an individual, the top tax rate is 33%. So if you're on the top tax rate, you have to pay a little bit extra tax, but not much. If you're on one of the lower tax rates, then you actually get a tax refund because, say you're on the 17.5 cents per dollar tax rate, then you would only owe them $175. You've actually paid through your corporation $300, and so you would get a $125 tax refund in that case. So this avoids the issue that many other countries have, is that the corporation pays tax on the profit, then when the profit is paid out to you as a dividend, you pay additional tax, and it avoids this problem of double taxation. Any questions on that before we move on? Okay, everybody have it? The other thing they do in New Zealand is that if the corporation, let's say the corporation only paid 200, say it paid 200 in tax to the government, they can actually tax you at source, that other $100, and that also goes off to government, and that would actually appear on your tax statement that there was an imputation credit and a tax credit, and you're allowed to claim both of these. So in the end, in both cases, you would end up with a net $700, and in most cases, for most investors, that $700 is yours to keep. You don't have to then turn around and pay additional tax on that. If you're in top tax bracket, you pay a little bit, but not much. Okay. Now, another issue around the tax with these things, with stocks, is we hope as investors that we get some appreciation in the stock value. So ultimately, after a long period of time, you're going to probably sell it, and you'll have a capital gain. In New Zealand, under normal circumstances, you do not pay capital gains on stock. So if you buy common shares on the stock exchange and you make a profit over time, and you have a capital gain, it's not taxable in New Zealand. Most places in the rest of the world, including Australia, there's a capital gains tax to be paid on that. The exception is if you're classified as a trader. So if you're classified as an investor, and most people are because they're buying and holding for long periods of time, in the case that you're buy and hold type investor, you do not pay tax because you're not trading. But if you're classified as a trader, it means you're actively trading for capital gains, then the gains from that type of trading are taxable in New Zealand. So most people don't trade actively simply because they get hit with a big tax bill if they do, and that reduces your returns. Okay, let's go back to, what about preference shares? Any features of them that you know about? Yeah, go ahead. Okay, so one thing is if you have to decide as a corporation who gets paid dividend first, the people with a preference share will be paid their dividends in full before common stockholders get paid. Any other differences? Yep. Okay, second point there, if there is a liquidation, common stockholders at the bottom, preference shareholders are one above that. They're still below everything else, but they're one up. So they're slightly less risky, preference shares slightly less risky than a common stock. Any other features of them? Yep. Okay, so there's one thing that's quite unusual in one sense, is because even though a preference share is an equity, you are part owner in the corporation, in most cases, you don't get to vote if you own a preference share. So you have no voting rights, and all the voting rights are attributable to the ordinary common stock. I think that's the three main ones. There are a lot of details around these things. In fact, there's very few of them issued in New Zealand. Let's go along here. They're often considered a hybrid. Okay, so that means that they have features of both debt and equity, and we've met hybrids before. So this is one of them. In the United States, you see a significant number of preferred shares being issued because of the tax treatment that they receive. Now, here, there is no special tax advantage, so you don't see a lot of them, although there are some around. These ones, too, this is the ASB preference A and B shares. They are two of the few preference shares that are actually on issue in New Zealand. And if you go and look at how they behave, they are priced very much as if they were simply a bond. They do not seem to behave at all like an equity in terms of their pricing. Now, in terms of the corporation, the dividends paid on these stocks, they're not tax deductible. If you think of a bond pays interest. That interest is an expense for the corporation. For a preference share, when you pay the dividend, that's not an expense. That comes out of your profits. And we said that last one. Oops, sorry. So there's a bunch of provisions. And again, in this part of the world, because we see them so rarely, we don't see a lot of different types of provisions for paying the dividends. There are in overseas jurisdictions where they issue these quite a lot, a number of things. So the first one is cumulative provision. If a company does not pay a dividend on a common stock, that's not a default. Okay, it's not like a bond. If you don't pay your coupon, that's a default. And a preference share, you don't pay it, it's not a default. But if it has a cumulative provision in the preferred stock, what that means is if it misses the dividend payments, then they have to make up those payments before they can actually pay anything out to the common stockholders. Now, if they're participating, this makes them behave much more like an equity rather than like a debt. So participating means that they have this set rate of dividends, but if the company actually does well and the earnings increase, and it's usually specified initially in the contract how that works, then the dividend payment will rise. And if you have a preferred share that has that sort of property in it, that they're participating, then the pricing of the preferred share will behave more like an equity than like a debt. If you have the other one, which is the one we tend to see in this part of the world, a non-participating, they have a fixed level of dividends. It doesn't matter what happens to the corporation, unless it's broke, of course. The corporation becomes more and more profitable, but you don't get any more than is specified. If it has that sort of provision in it, then you'll see the pricing behave very much as if it was just a bond. And then, of course, there are some of them. In fact, those ASB ones, the ASB preference A and B, they're both adjustable rates. So they have a benchmark that they fix their adjustable rate to, and once a year they change the dividend rate on those bonds, on the preferred shares. And if you have an adjustable rate preferred share, again, in terms of its pricing, it behaves much more as if it were a bond than it does as if it were an equity. Okay, any questions on any of those? Right, move on. Now, sometimes you see options in them, okay? Sometimes you see options in these things, so sometimes they're not issued forever. In fact, the ASB ones, they both have a call option built into them, so if the company decides it wants to remove them from its books, it can call them in. Now, they may be what's called contributing or partly paid shares. Now, it's kind of obvious what that means. They're not fully, you didn't pay all your money for them. Why would a company issue a share that is not fully paid up? Say it was issued at a par value of $1 and you paid 20 cents for it. Why would a company do that? All very quiet. Well, one of the things about the equity market as well as the bond market, because they're capital markets, what they're doing is trying to raise funds for long-term capital investments. And if you have, say, a project going to take a long time to build, an example that actually came up in Australia, where people got bitten with this provision, is that a company was building a toll road. So they're going to build a road, a long road. They expected it would take about 5 years to construct the road. And once it was done, everybody who drives on it had to pay. And of course, you could grab all the money you need straight up front if you wanted to, but because it's going to take 5 years to build, you may do something like this, issue a partly paid. And so say it's going to take 5 years, and each year you pay 20 cents worth of the dollar par value, then in the first year it gets 20% of the money comes in the first year. At the beginning of the next year, you pay another 20%. Third year, you pay another 20%, and after 5 years, you've paid the full amount. And typically, if they're partly paid, the outstanding amount to be paid is a legal obligation. So that if you buy these things, then you're legally obliged to actually pay up as these things come due. So they are used. In fact, there was this case in Australia which actually bit people, is that the company that was building the road fell upon hard times, and these things were trading at like fractions of a cent. And so for an outlay of about, I think approximately $1,000, you could buy yourself an obligation of about $1 million if you really wanted it. And people, not knowing what they were buying, actually did that. And they found to their cost that partly paid, when they were called upon for the money, they'd actually gone in over their heads, and people really found it pretty tough when they did that. But they are used for that purpose when they have these long-term projects and they want to have a steady income of capital coming in to finance them. Okay, any questions on that? Okay. Okay, question here. Why are convertible securities more attractive to some investors than simply holding firms' either preference shares or their bonds? What's the big advantage of a convertible? Yep, go ahead. Reduce the risk how? Okay, it's not if the price of the bond goes, it's not the price of the share goes down that you convert. If the price of the share goes up, you convert. Okay, so one is it does give you a level of protection. So if you buy a convertible security, either a convertible preference share or a convertible bond, then if things don't go well, you can simply hold your security, and hopefully if they don't go out of business, they'll continue to pay you either your coupon or your dividend as they're supposed to. But with these things, almost all convertible securities are issued with the intention that the company does well, and ultimately you'll be able to convert it to shares and get an extra return on them. So they are less risky than buying the stock. Okay, anything? One thing I might say about this is that when we're talking about preferred stock versus convertible notes, which again, preferred stock in terms of taxation from the company's point of view, the dividends are not tax deductible. They are simply paid out of profits. Whereas if it's a convertible note, it is a debt, and interest paid on those is tax deductible. But in both cases, the company will issue these things with the expectation that over time it'll be worthwhile for these people to convert, and they will not have to, if they're particularly a bond, they will not have to repay it. And what they're essentially doing is pre-selling the company's stock at a higher price. And if it works out as it should, then you actually end up with a higher return. Okay, any question on that before we go to the primary market? Okay, primary equity markets. What's the purpose of the primary equity market? Yeah, go ahead.
Primary market is like an IPO, it's like the first time the shares are sold to investors or individuals.
Okay, so first time they're sold to the investors, and what's the purpose of that? Yeah, to raise capital for long-term investment. Now, if you think about how this works, as a stock works compared to a debt, if a company issues a bond, then ultimately almost all bonds have a finite life, and in the end, the company will pay that back. Now, with a stock, they're issued as a perpetuity. They have no maturity date, but sometimes, what they do is they'll actually buy back shares. So actually buy back shares and cancel them. And one of the strange things when we say that the stock market exists for long-term capital, raising capital for long-term investment, is that often that's, well, not often, it's in the U.S., this is some earlier data. This is the net issuing of equity on the U.S. market. So this is the positive ones up here, of which there are 2 years, 2008, 2009. And the reason those 2 years are positive, primarily this because financial corporations need to raise capital to recapitalize themselves. All these other years, there has been a net repurchase of equity. So although there are issues of new equity going on, what is happening in the stock market in the U.S. is typically more equity is being returned to shareholders than is being brought in terms of new issues. Now, this is a little bit more up to date, but this is a much more complicated graph. This is from the Bank of International Settlements. This is their data. So this is the U.S. data here so the red ones. These are their IPOs from the year 2000 up to 2014. So the red ones are IPOs. These are the ones that have never been listed on the stock market before. And, of course, they're raising money through a new issue of shares. The blue ones, and we'll come to what these are fairly soon, this is the issuing of new shares by companies that are already listed on the share market. So most of the money that's coming in is new shares being issued by companies that are already there. So that's the money that's coming in. So that's what we traditionally think of what the U.S. market or any share market should be like, is that this should be money coming in for capital investment. But when you net that out, take out the share buybacks, you end up with this line here over this time. So again, this is Bank of International Settlements data. So here we're seeing at that point, that's the most recent data point, 2014, more than $3 billion in equity is being returned to the shareholder. So there's actually more equity being paid out than is being brought in to the U.S. market. And that is kind of an unusual feature, because you don't normally think that this is the purpose of the market. You think normally it's to bring money in for investment, but in actual fact, what they're essentially saying is, we don't have any good use for this money, so we're returning it to you. That's essentially what's happening here. Now, this is quite interesting in some ways. If you think, hope I don't get too political. In the United States, if you look at the Rust Belt, and you think about all those industries that used to be there, and they're not there anymore, and that's why they call them the Rust Belt. And you think, well, why did they die? Why did they die? And basically, everybody can blame all sorts of stuff, but one of the things that almost no one ever talks about is the chronic underinvestment of American businesses in themselves. They just weren't doing it. And in fact, you can see businesses closing down and shutting up shop a full decade before the first free trade agreement was ever signed in the Rust Belt. They came, plants came to the end of their economic life. Companies decided to simply shut it rather than upgrade it. And that was occurring long before, any nasty, horrible free trade agreement was ever signed. And so when we see this going on, here we're looking at more than 10 years of data. Throughout that entire 10-year period, more money is being returned to shareholders than is being brought in. And essentially what they're saying is, we don't have any good investment opportunities. Here's your money. And if you think, what politicians say about this stuff, there is a real problem with chronic underinvestment in these businesses. That's where one of the real key problems is. But it's not one that any politician wants to mention, because not much they can do about it. Okay, any question on that before we move along? Yeah, got a question?
Is this something to do with the domestic interest rate? Say that you said that there's not many investment opportunities. I say that if the base up, then the opportunity cost of capital is going up. So can say that they have not many projects to fit in the investment. That is the way it's saying.
Okay, so if you think of the cost of capital in terms of interest rate, I mean, particularly even in, particularly say post 2009, interest rates, if you look at like federal funds rate, is effectively zero. And long-term rates have dropped down to historic lows. They've never been this low before. So the argument that the cost of capital is too high doesn't hold up, particularly in the 2009 on period, but even in some of the earlier periods where there's not as much going on here. But after the 2001 crash in the stock market, the interest rates again at that point were lowered close to zero. Okay, there's not as much being returned there, but we still have a net return of capital compared to this period. This is a lot more here. So the argument that the cost of capital is too high, it doesn't stand up because the interest rates simply are, like over the last 5 years or so, have been as low as they've ever been in history.
So why, if the interest rate is so low, why the cost of capital is so high? What caused it?
It's not necessarily that the cost of capital is so high. I mean, you probably have to talk to the CEOs and why on earth they're not investing in their companies. But like, if you go back to 10 years before the first free trade agreement was ever signed, you look at those steel mills that they started closing down. It was actually pretty expensive to refurbish them. Like there was some in the Mahoning Valley. Okay, and the last new one was built was in 1921. Okay, so by the time you get to the 1970s, they're pretty darn old. And when those things got essentially to the end of their economic life, the company that owned them has two options. One is refurbish, replace, upgrade, or close it. And even at that point, the argument that it was unprofitable to do that didn't stand up in practice. But the amount of money required was pretty high. I mean, they were looking at about $1 billion per plant to do the replacement. And from what I understand, it was hard to make a clear-cut financial argument that the only option you had was to shut them. Even then, they had options for rebuilding, replacement. But they just didn't do it. And it's kind of hard. It's kind of hard. I don't really understand why they decided to do this. Simply chronically underinvest, but it's still going on. And so when people get mad because they've lost their jobs and they blame the free trade agreements, in actual fact, it's people deciding to underinvest, even though there should be opportunities there. Maybe that's the best way to say I don't know. Because actually, one thing I've actually been doing in terms, how many are doing 201 at the same time? You know about capital structure? Where's my other graph? In actual fact, what's happening here is there's a big shift in the capital structure of corporations, and this one here. The red line is the issue of debt, and the blue line is the share buybacks. So what they're doing, in many cases, is simply restructuring the corporation. Okay? They're loading the corporation up with debt and paying out the equity in these cases. As in one sense, that sort of makes sense because debt is so cheap relative to equity. Okay, any other questions on that? Oh, you got another question? Go ahead.
Sorry.
It's all right.
Mentioned about the capital structure that if the company has more debt, which means that they assume that they have no default risk, right? They can say that because apparently the debt, if the interest rate is going, it's going down, which means the debt is going to be more expensive, and it's So in this case, they just assume that they're pretty much gonna think that the interest rate is going down. Oh, sorry, it's going here.
Yeah, they think, I mean, in terms of interest rates going down over that period of time, and they're right, they're basically down at, almost down at zero. They're as low as they've ever been. But again, I mean, in terms of capital structure of corporations and stuff, I mean, that's, there's actually a third-year paper on corporate finance that goes into this a bit more. You get this in 201, but sort of impinges on what we're doing here. Anyway, we'll carry on. Okay, so how many different ways are there to bring new shares to market? Nobody knows, right? Okay, so there's several different ways to do it. One of the most common one is the initial public offering. So if a corporation has never been listed on the share market before, they engage in an initial public offering. Typically, they do have to hire an investment bank to do this. And so in terms of how this works is here's the corporation going to do an IPO. They hire an investment bank to do it, the real things. Here's the end investors who are going to buy the shares. And so they pay X dollars to the investment bank. They pay them Y. And so the X minus the Y equals bank underwriter's fee. So the investment bank simply brings in more money from the investors than it pays out to the corporation that's having the IPO, and that's its fee for doing that particular work. Actually, I might go out of it. So they're only ever issued once in the primary market. Once that's happened, typically they are listed on a secondary market. Very few are unlisted. So most of them will go on to the secondary market, where they'll then be traded amongst investors from that point. So when you're actually going to do this, you're going to say conduct an IPO. It's typically split into two pieces, and there's a big piece, by far the biggest piece, which goes into the institutional investors. So, things like mutual funds, insurance companies, and so on. And then typically there's also a much smaller group for the retail investors. So that's people like me and you. If we want to buy them on the IPO, then we would have to apply for the shares in the public pool. Now, there's various ways of setting the price, and probably the most common one is simply for the investment bank to value the corporation and set the price. But in the case where we've got a lot of uncertainty around it, they might use a thing called a book build. And in a book build, it's a fairly straightforward process. It's simply a competitive bid. So what happens is, not in the public pool, but in the investor pool, is they simply call for competitive bids from the potential investors. These are mutual funds and life insurance companies and so on. And they'll apply for a certain number of shares, and they will tell you what price they are prepared to pay. And then what happens is the investment bank simply lines up, takes one of the highest bidders until they've sold all of them. And then at that point, the price is set at that point for the public pool. Now, one of the problems with this for the private investor is that typically if you apply for shares under this as a private investor and there's a book build going on, you actually don't know what the final price of the shares will be. And that can, for small investors who are not experienced in the share market, they find this quite spooky, the fact that you don't know what you're going to have to pay. And in fact, when the government sold down some of the power companies, on one of them they used a book build, and they got a much, much smaller application from the general public in terms of number of shares that people wanted than they did in the other ones. And they attributed the low interest in this to the fact that they used a book build to set the price. So when people were applying for shares, they did not know what they were going to pay. But if you look at it the other way, is that because it's a competitive market, you're probably going to get a very fair price for the shares. So in one sense, if the price is set by the investment bank, you've got to trust that they got that right. And they're probably more likely to get it wrong than a book build. So if you see a book build, you probably think, well, that's actually more reliable than knowing what the price is set as it is set by the investment bank. But if you're not very experienced, that tends to spook people, and they tend to think the problem is the other way around. And certainly when we saw it when they're trying to sell down power companies, that the very fact that we had a book build scared a lot of people off. Okay, any questions on that? Okay. Okay, so this set of questions here is about raising further funds through equity issues if you're already listed on a share market. So you're not doing an IPO, you have your shares on a share market, and now you want to issue more. So how do these things work? First up, rights offering. How does a rights offering work? Yeah, go ahead.
You offer existing shareholders the right to purchase additional shares in relation to one of their primary holders.
Okay, so you go to existing shareholders and you offer them the right to buy further shares in proportion to what they have. And if you think about why this might be attractive for an issuer, if you think, who thinks my shares are good? My current shareholders. So if you want to raise more money, one of the logical places is to go current shareholders. And so one way of tackling that is through a rights issue. What about a private placement? What happens? How do you get more money there? Okay, well, it's very much like the private placement of the bond. You hire your investment bank, and they sell the shares directly to some large investors, small number of large investors. So the advantage of the private placement is if you need capital in a hurry, this is usually the fastest way to get it. Because with a rights offering and some of these other ones, you have to meet a lot of legal obligations and regulatory obligations. With a private placement, typically you can avoid all that stuff. And you can, if you need to raise money in a hurry, like some financial corporations had the capital seriously eroded, you need to raise new capital real fast. A private placement is usually the fastest way to do that. What about a dividend reinvestment plan? Yep. Okay, so instead of paying a dividend out in cash, the company keeps cash and you get new shares.
Yeah.
Okay.
The benefit being is that, especially if they want that additional equity, they don't have to pay out that cash, so they can actually keep it.
Yeah.
Instead of letting the investor decide whether they want to or not.
Okay, so that allows them to keep the cash in the company to grow the company rather than paying it out to the investor and hoping they'll buy some more shares at a later date. Yeah. Now, one of the things about these, again, when you think about who thinks my shares are good, my current shareholders think my shares are good. And typically, where dividend reinvestment plans are offered, you'll often see above 50% take-up of them. So people are quite happy to do this. And so if a company is growing pretty steadily and they need new capital on a regular basis to continue their expansion, offering a dividend reinvestment plan is often a very good way to continue to retain cash inside the company rather than pay it out. What about the final one? Oh, do you have a question?
Yeah. I'm just wondering for this, if dividends, the investment plans, if they do any earnings, is it considered that they like not pay out any dividends, that they just retain all the earnings? Do they do the same thing?
No, it's not a retained earning. It's not a retained earning because if they retain earnings, okay, you as the investor don't have to pay any tax on that. If you are in part of a reinvestment plan and the dividend is paid and you're in that and instead you get shares, then that payment is taxable. Okay, so it is different from retaining cash, just purely retaining cash inside the corporation. It is money that they have declared a dividend. It then is taxable for the end investor. But it allows that money to stay in the corporation because you have a significant chunk of your investors who would like to simply buy more shares. Okay, so it is different. It's different from simply having retained earnings. So, like if we do a diagram of what's happening, draw a picture. So if they did this, let's say here's that $1,000 before, and let's say there was $300 out there in tax going on, and then they kept, another 100 retained earnings. Of that $1,000 in profits, you might be paid out 600. Okay, so they retain these earnings. That's retaining. And then this stuff here, if you're part of the reinvestment plan, that would be $600 would be invested in new shares. If you're not part of the plan, that simply gets paid out. So they can retain their earnings to grow the business. This is optional. This is optional. So if you want to be part of the scheme, you opt in. If you don't opt in, you simply get paid out. So it is actually structurally different to a retained earning. Okay, any other questions? Right. Okay, what about a stock dividend or share dividend? Nobody knows what that is? Okay, we'll move on. Now, stock dividends is kind of a funny thing because it actually doesn't do anything for you. Let's see. Yeah, a stock dividend increases the number of the shares outstanding, and so they're kind of odd in that all it does is increases the number of shares in the business, but it doesn't actually change the value of the business at all. And one of the things that these things get argued about is whether they should be taxed or not. Now, often when you see a share dividend, okay, one way of thinking about it, if you think about the dividend reinvestment plan, if you wanted to be involved in that, you had to opt in, okay? With something like this one, shares one, often they have an opt-out clause. So dividend reinvestment, you have to opt in to get the shares. These ones, if you want your money, you have to opt out. And the way that is typically done is that they'll simply issue dividend of shares, and then if you really wanted the money, you have to then sell those shares back to the company. So this is actually used in this sort of circumstances. If the firm finds other forms of financing either difficult to obtain or expensive, then they can often use something like this. And one place where it was used in New Zealand, Contact Energy used this for about 5 years after the 2008 financial crisis. At that point, it was almost impossible to get further debt financing. And so they went down the route of having a share dividend. And so they would declare share dividend. And they would always offer you the opportunity that if you really wanted the cash, then you could sell them back. But most people didn't. People who invest in a company think it's a good company. And so when they get more shares, they simply hold them. But you could get extra cash if you wanted to. And for about 5 years, they used this as a way to continue to keep cash inside the business because they were undertaking a major development of a new power station. At the time when they started, it was like virtually impossible to get financing. Okay, any questions at this point? Oh, we got another one. Go ahead.
Just wondering for the dividends, that if the company decides not to pay out the dividends, does the investor, can you request them to pay out?
No. Dividend is completely optional. There's no requirement to pay them. So if the company decides not to pay dividends, then you're just out of luck. Okay. Okay, so time's run out. We'll pick it up at this point tomorrow. If you want to ask any questions, be around for a while. Otherwise, we'll see you tomorrow and carry on.